This is a very important standard, reason being that that a lot of companies have now started, because of obviously it has been like going on for the past many years, cross border trade, probably since this uh, you know since very long time obviously. But the thing is, how do you report it if a company is doing cross border trade such that they're buying goods in foreign currency? For example, if let's say uh, you know Zara buy garments from Bangladesh or India or Pakistan, right, or Vietnam. Okay, so they're basically transacting in, let's say, foreign currency, in their local currency, right? So in that situation, how do you treat the transaction? How do you record the transaction? That is very important. Okay, now this is what IS 21 tells us, and obviously it tells us more as well. Let's first start with this. Now, the first thing that you have to understand in this case is that there's there are two dates that are very important. Number one, the transaction date, and the second one is the reporting date. All right. Now, for transaction date, you will obviously translate. That means, for example, let's say the goods cost 10,000 rupees, right? And the rate is, let's say, 1 USD equals 100 rupees. All right.
What is this standard again?
IS 21.
Okay, fine.
All right. Now, in this situation, what would be the USD value? That would be $100, right?
Yes.
You understand? So $100 is basically at the date of transaction the value of the goods that were purchased. So, for example, Zara in US would record inventory debit, or let's say purchases debit, $100, and payables credit. Let's say I'm assuming that the cash was not yet paid, $100. All right. Now, that's the translation at the transaction date. Now, the point is that at the reporting date, this is very important. All right. At the reporting date, what you have to identify is whether the asset or whether the item that you're translating, is it a monetary item or a non-monetary item. Now, what's the difference? Monetary item is any item that has only one use, to be settled in cash. That's all. To be realized in cash or to be settled in cash. That's a monetary item. Non-monetary item is all items other than monetary items. So, for example, land, building, inventory, right? These are all non-monetary items. Whereas monetary items, for example, you've got cash itself, you've got, let's say, sometimes companies hold foreign currency as well, right? So holding foreign currency, you have to translate it at the reporting date as well. Okay. Now over here, monetary items, for example, receivables, no other use except for being realized in cash. Payables, no other use except for being settled in cash, right? So over here, if you see the transaction, you have one monetary item and one non-monetary item, right? So let's say purchases translates to inventory, right? If it's unsold during the year at year end, That means it's part of inventory. So inventory itself is a non-monetary item. For non-monetary items, let me tell you about the monetary item first, which is very easy. All right. Now for the monetary items over here, if you see payables, you translate at each reporting date and record any changes in the exchange rate in profit or loss. All right. Now, example. Let's say, because obviously for us, we have to settle in rupees, right? Because we have taken up a liability in rupees, so we have to settle in rupees, right? Let's try to understand over here what happens if I would like to, let's say, obviously settle the payables in terms of rupees, but the point is that rupee the exchange rate parity changes, right? At year end, let's say 1 USD equals 120 rupees. What's my liability right now? My liability is, sorry, 10,000 rupees, right? How many US dollars do I have to pay at year end? If I settle it at year end, how many US dollars I have to pay?
We need to divide it by 120 rupees.
Can you divide it by 120 and tell me the value?
Yes. So 83.3.
83 point.
3.
So I'll consider 83 only. Okay.
Yeah.
Now, my liability was at the transaction date, how much? 100? It has gone down or gone up?
It
It has
gone down.
gone down at the reporting date. That means if a liability has gone down without any settlement in cash, that means it's what? It's a it's an income, right? So basically, the double entry that you will record at year end would be payable debit
Earning
by the
earning
difference, which is
income,
17.
profit and loss.
Okay. So all monetary items are basically translated at year end at the reporting date exchange rate, and any changes as a result of those exchange rate, as a result of the movement in exchange rate, is basically taken to the P&L. Okay.
Yes, okay, clear from my side.
Can I move on? Now,
Yeah.
as for the non-monetary items, guys, remember non-monetary items do not need to be retranslated at reporting date. Okay. You don't need to retranslate unless. So do not retranslate means hold it at historical cost. Once you have retranslated it at the transaction date, you don't need to do it again at the reporting date. Okay. Or fair value change. Okay. Now, impairment or fair value change. Guys, remember, I won't make this example complicated, but trust me that this can get very complicated sometimes. Okay. And it has it there was a time when it became a headache from it became like the worst nightmare of my life. There were a lot of transactions going on, and things were messed up in one of the accounts of my audit client, and it was like a huge headache. Okay, so like I said, it can get messy sometimes, but the point is, it depends on how good you are at maintaining the records. Okay, now, impairment or fair value change. Guys, remember that this fair value change or impairment would ultimately have two things. Number one, change in the value of item, change in the value of non-monetary item, and change in exchange rate. Do you guys agree? Guys, there could be a change in two things. Let's take a very small example over here, right? For
Before we
example,
go, for example, just I have quick one question.
yep,
Um, Non-current asset. I feel it's the same for non-monetary.
non-monetary item basically
Is
includes
it
a
not
non-current
the
asset.
same?
Yes.
Oh,
Mm.
okay. So it's part of it, right?
Yeah, yeah, yeah. So let's say
Okay.
you acquired a PPE at, let's say, so that's 10 million, let's say, Swiss francs. Okay. Now at
Use
that time,
Bahraini dinar. Why all of this is like difficult currency? Bahraini dinar is nice. BHD. Easy.
all right, what's the exchange rate with dollar?
0.375.
0.375.
Yeah.
So
The
one
Bahraini
USD.
dinar one,
Oh, Bahrain
it will
dinar
be,
one.
yeah. Okay. US
Point,
dollar is point three
sorry,
seven five.
0 point. So that's 0.375.
Yes.
All right. That's exchange rate. Okay. Now, this is basically the exchange rate at the transaction date. Okay. Now, so this is the item. So according to my
Hello, sir.
books, yes,
Sir, I think 1 USD is 0.375 USD.
one USD is,
0.375 USD.
oh, okay.
Because
So
that makes sense, right? Yeah.
no, Bahraini dinar could be a higher
But
BH.
USD,
I gave the correct one, by the way. Bahraini dinar is 1 dinar. It will be equal point 0.3. Uh, like $1 is point 0.3 dinar.
$1 is 0.3 dinar, right?
Yes.
okay.
Previously it was written wrong, right? Now I'm writing it right.
I don't remember.
Yeah, now it's right.
Yes, now it's correct. Yes,
Okay,
now
okay,
this is
all right.
correct.
So
Correct.
this is 10 million Bahraini dinar. That means if 10 million Bahraini dinar, how much US dollars would that be?
Minus the. Okay, I'll make it for you 1 second. Okay, 10,
26.6.
26.667.
Exactly. So 26.6 million USD,
Mm.
right? Now, for example, I'm assuming that this is land. We don't depreciate land. Okay, we know this. Now, at the reporting date, and I'm holding this land at revaluation model. Okay. So at reporting date, because it's situated in Bahrain, okay, the fair
Why we
value,
don't depreciate land? Like, why we don't
because
depreciate
you
land?
cannot allocate a useful life to the land. You cannot determine the
Um,
level of economic benefits you will generate from a land. Land can have multiple uses, multiple economic benefits. So, it's not easy
yeah,
to
but
determine.
it's like, if like how you can like record it direct, it will like affect in your BNL and everything because it's a big amount suddenly.
No, this is the I'm capitalizing
Capital?
it. Yeah, I'm
Okay,
capitalizing it. Okay.
okay, done.
Now the
Okay.
value has changed. So in Bahraini dinar, the value has gone up by how much? 2 million, right? But at the reporting date, the exchange rate is now this. There's a change in the exchange rate. All right, dollar has strengthened. So which ultimately would be,
For
so in US dollar terms, if you see, it is actually a downward revision. Yes,
correct.
it's actually a downward revision, right? In US dollar terms, it
Minus
has
1
fallen.
million. Yeah, because the US dollar at the date of the transaction it was lower than the
Yes.
current date at the meantime.
Exactly. So technically, what we can easily do is, so 12 million is the new value. You can compare it with the historical value, right? So 12 million with the historical value will get you 32 million, right?
Mm-hmm.
And 12 million, so you have at the new value will get you 25,263,158, right? So if the exchange rate wouldn't have changed, I would have actually made money on this. That means I would have actually, I would have witnessed a gain of 5.33.
Positive 5 million
Exactly,
instead of the minus
exactly,
1.4 million.
exactly. So this can also be calculated at the historical rate. All right. But the point is the rate also changed. So you can separate it if you want to. There's an exchange loss over here of 6.7 million, but in terms of the property has gained value. But ultimately, why we don't do it usually is because what IAS 21 says is that you will treat the entire gain or loss, including the exchange gain or loss, that is the gain or loss on translation, as per the relevant accounting standard. So, as per PPE, I'm obviously, because it's IAS 16 and it's revaluation model, so I will take it to OCI. And this exchange loss in our case will also be taken to OCI. You understand? So if let's say it was, if for example, you guys know IS 40, right? Investment property. Now in IS
Yes.
40 investment property fair value model, fair value changes are taken to the PNL, right? So in that case, if let's say it would have been an exchange loss or an exchange gain, it would have also been taken to the PNL. Similarly, IAS 36 impairment. Let's say we're doing impairment of a non-monetary item of, let's say, land only, Bahraini land, for example, right? In that situation, again, impairment expense is taken to the PNL, not to the OCI. So any translation loss or gain will also be taken to the PNL. All right. So for monetary items, it's always PNL. For non-monetary items, it depends on what standard is being applied and what treatment does the standard ask you to do for the relevant item. That would be the treatment for exchange loss or exchange gain. You understand?
Yes.
Perfect. Now, let's move on with some, some critical concepts.
Okay, but just before we go, I have one question. Now,
Mhm.
we which like rate we should consider it now, because it's like based on the question, is there's any specific one we need to use it, or it's fine, like we can use this or this, or we need to use the actual one, like when it's increased.
I'm coming to that. I'm coming to the use of rates.
Okay.
All right.
Because like this, like I have the both rates. I have the historical one and I have the
Basically,
current
you
one.
have to use the transaction date exchange rate,
Mm-hmm.
and at the reporting date, you have to use the reporting date exchange rate. The difference between the two
It
is
will be goes
called
to the foreign currency exchange gain or loss.
exactly. So this
Okay.
is basically treated as translation loss or gain.
Yes. Okay. Got it.
Now, you know what the problem is? Problem is that a lot of businesses are now huge. Okay, it's hard to determine where they're getting their main revenue from. It's hard to determine what currencies they're playing in, what currencies affect their business the most, right? But they choose one currency only to present their financial statements in. All right. For example,
Okay. Makes
Toyota,
sense.
right? Toyota produces the consolidated financial statements in Japanese yen. All right. But Toyota is impacted a lot by the European market, where probably the euro and the pound sterling is the currency, and the US market, where the dollar is the currency. The point is, how do you determine? So, this, for example, for Toyota, over here becomes the presentational currency. What has become?
The presentation currency.
Presentational currency. Currency in which the financial statements are presented.
Mm-hmm.
Presentational currency is the currency in which the financial statements are presented. But this currency, if it's the same as the functional currency, perfect. There will be no problem, right? But if the functional currency and the presentational currency are different, then there will be translation at different rates and different time. Okay. Now the point is, we know what presentational currency is. Can a business choose its own presentational currency? 100%, 110%. The business can choose its own presentational currency, but can the business choose its own functional currency? No. Functional currency depends on certain factors. Let's look at what those factors are. Now, first we need to understand what exactly presentational or what exactly functional currency means. Functional currency is basically the currency of the primary economic environment in which the entity operates. All right.
Um,
Environment in which guys, I'm getting some background noise. Can you please check? All right. So currency of the primary economic environment in which the entity operates. What does that mean? IAS, obviously, this is a very vague statement, right? IAS 21 gives us certain primary and secondary factors on it. Let's see what those primary and secondary factors are. Now, there are, guys, remember, there is no hard and fast rule over here. All right. It's like, where is the tilt? Towards which currency is the tilt based on the factors given? These factors are not the conditions. These factors are not like conditions. You understand the difference between conditions and factors is like huge. Okay, conditions means that you cannot move or you cannot report something without satisfying particular points. Factors are you outweigh, basically you weigh out the factors, right? If it's a tilt towards, let's say, USD is your functional currency. If it's a tilt towards pound sterling becomes your functional currency. It depends. All right, let's see. First factor, or I'll summarize it. Even though Toyota Global reports or presents, let's call it presents, its financial statement in Japanese yen, but a huge chunk of their inventory or a huge chunk of their business gets affected by USD yen parity. Why? Because they sell a lot of their product in the US. All right, they sell a lot of their product in the US. Majority market for Toyota is in US. All right, so that's one point. Second factor, that's competitive forces. Second factor, currency of the country whose competitive forces, that means the competition and regulations determine or affect the sale price. Okay, so the laws and regulations of that country in which you're operating, if, for example, if it's not your local country, if it's not the same country that has the presentational currency in which you're reporting your financial statements, in which you're presenting your financial statements, then obviously your functional currency is different from the presentational currency. Guys, remember one thing: IAS 21 will not apply if your functional currency and presentational currency are the same, because there is no need to translate then. Okay, the only factor over here is if these two currencies are different. Okay, third factor, now these are all primary factors I'm talking about. Okay, there are certain secondary factors as well. Secondary factors, IS21 says that you will assess secondary factors if and only if the primary factors they do not help you enough to decide what would be the functional currency. All right, that affects the input costs, for example, labor, raw material. All right, currency that affects the input cost, for example, countries that have companies exporting garments: Pakistan, India, Bangladesh, Vietnam, top exporters of the world. All right, the point is, for us, yes, the labor cost is being incurred in rupees, the raw material is being incurred in, the cost of raw material is being incurred in rupees. All right, but our dollar to rupee parity determines the entire sale price. the market of US affects our companies a lot. All right. The markets of US affects our companies a lot. The point is it like the entire business that is setting up the, yes, we have export units, right? But the companies over here also have local, they have units that are catering to the local demand as well. Probably it's like a 60% export unit, 40% export unit, 30% export unit, right? But the remaining is for the locals, right? So if you see the tilt, countries whose competitive forces and regulations determine or affect the sale price, it's Pakistan or India or Bangladesh. It's their local country, right? It's their local with regulations. Why? Because the local regulations define or decide. Obviously, I won't say that control, but they decide. The decisions decide where the exchange rate is headed. Okay, and that affects the business. Federal Reserve of US is printing like approximately 1.3 trillion dollars. That will affect the global economy, yes. But your decisions, your local decisions will affect the local parity against USD, which will affect your inflows, which will determine your price. If, for example, recently, right, the dollar has gone down against, the PK has gone up against dollar, right? PKR has strengthened. Okay. Now the point is for exporters of both services and goods, for people like us, it's it's a loss. All right. Let's say 1 USD would get us 160 rupees, but now that same 1 USD is now getting us 155 rupees. So it's a loss for the exporters, right? And what determines it, like the local regulations, the local competitive forces, the local macroeconomic situation determines the exchange rate parity. So that's a tilt towards PKR, right? Similarly, this is also a tilt towards PKR. So if you see that it's 2 out of 3, it's PKR, that means functional currency should be PKR. You understand? That's how you assess. But like I said, these are only the primary conditions, primary factors, not conditions, primary factors. Let's look at secondary factors. There are 2 secondary factors. Your accounting standard says that if these primary factors do not help you decide which functional or what currency should be the functional currency, in that situation, you'll have to look at 2 further points. Number 1, funds for financing are generated. That's number 1. All right. So obviously it comes to the financing part. What denomination of funds you're using? Is it PKR, INR, Bangladesh, whatever it is, right? Second, currency in which cash flow from operating activities is being retained. All right. So now it comes to 2 things. Number 1, financing, and number 2, operations. All right. You guys get it? So again, like I said, if the functional currency is different from the presentational currency, the factors that you have to see is obviously these. First primary and then secondary. The red ones are the secondary, and the black ones are the primary. Okay. Once you determine the functional currency, if it's the same as the presentational currency, you're good to go. You don't have to apply any IAS 21. You move on. But if the functional currency is different from the presentational currency, you'll have to translate. And the methodology of translation is the same that I told you over here. The difference between monetary and non-monetary. Okay? You guys get it?
Yes.
Yes.
Perfect. Now, another factor. What if you have a foreign operation? What if you have a foreign operation? That means, let's say you have a branch or a subsidiary, right? Because for you, if you are the if let's say you're the parent, you are the one producing the consolidated financial statements. You are the one producing the group financial statements, right? The problem is, in order to produce the group financial statements, your presentational currency, basically the functional currency, I would say, right? The functional currency should be okay. The functional currency could be different, right? But the presentational currency should be the same, at least, right? You guys understand this? So it's basically two things over here. Your, as a parent, your functional currency and presentational currency are the same, fine. But the subsidiaries or the branches presentational functional currency should be the same as well as yours, right? But it certainly won't be the case because that's foreign operation. They're basically, for them, if they apply the primary and the secondary conditions, they're probably, let's say, if I run an operation in Dubai, so for me, the Dubai operations, when they apply these primary and secondary factors, they will get this as their functional currency. And for me, as a parent, this is the functional and the presentational currency. Point is, how do you make sure, or how do you consolidate the financial statements? This is a bit tricky. All right. This is a bit tricky. The translation over here becomes a bit tricky. All right. You guys understand this? Which obviously I will explain you.
Yeah, we understand.
Now, like I said, the problem lies where? That the parent company, right? The parent company is in Pakistan with a functional and presentational currency of PKR. The branch or the foreign operation, I would say, is in Dubai with a presentational or a functional currency, okay, in Dubai. All right. Now the problem is, how will you consolidate? How will this Pakistani company consolidate this Dubai company or Dubai branch? That's the problem. Okay. Now, at the date of acquisition, I'll start from the very beginning. When Pakistani company acquires, and I'll go with it, I'll basically briefly explain you this, because when you look at the topic of consolidation, that is where I like we'll do questions on it. Like literally, we'll do consolidation questions on it, so that you guys understand it better. Okay, from the numerical point of view. Remember one thing at the acquisition date for me, because I have to report it in PKR, right? I will record the goodwill, the net assets, right, of the Dubai branch, or not the branch, but let's call it a company, right? Now, the goodwill or the net assets at the date of acquisition will basically be reported. So let's call it net assets at the acquisition date exchange rate, right? So goodwill and net assets will be basically reported or translated at the acquisition date exchange rate. Done. Because the day I acquire it is the day I basically take over all the entire net assets and I calculate the goodwill of on basically this company, right? Next step, I have to go and compare it at the same things, reporting date, exchange rate. But the problem over here is that an increase in the net assets will also take place. So over here, these were opening net assets, right? Opening net assets means net assets at the date of acquisition. This will increase by some profit or decrease by some loss. Do you agree? By the foreign operation. Okay, by the foreign operation, whatever profit foreign operation has earned, whatever loss that foreign operation has incurred, will basically affect the opening net assets of the foreign operation that I have acquired. Do you agree? And you will have closing net
Yes.
assets. Now the problem is opening net assets was translated first at the acquisition date. Now the same opening net assets becomes part of the closing net assets, right? And will now be translated at the reporting date. And this profit over here, because it's for the year, will be translated at the average rate, average of the year. Now, is there anything else IAS 21 says about this? Yes. IAS 21 says two things. Number one, all P&L items, all items being taken to the profit and loss statement should be translated at the transaction date. All items being taken to the P&L should be translated at the transaction date. All items in the statement of financial position, which is the balance sheet, should be translated at the opening rate and at the closing rate. Opening rate is basically the last year's closing rate, the rate of the last year reporting date. Okay. So if let's say your reporting date is 31st December, right? So 2021 would be the current year and 2020 would be the last year, right? So your SOFP items will be translated at the opening, sorry, at the opening and at the closing. Whereas the P&L items will be translated at the transaction date exchange rate. But IAS 21 also gives an exception. It says if determining the transaction date exchange rate is difficult because of the volume of transactions, you can use average rate for all the P&L items. You can use the average rate for all the P&L items. Okay? Do you agree? Now, guys, remember one thing. You know what the problem over here is? If you
Um,
see, yes,
no, I was saying like the average rate, it makes sense because it will give us the average. So in case if there is any increase or decrease, then we
you
will
see,
take the
if the
average
operation
for the
is small,
BNL.
if the operation is small, right, it's easy to identify the transaction rate exchange rate. But if the operation is of such a huge size that determining the transaction rate exchange rate for each particular transaction, obviously it becomes difficult, right? So you basically IAS 21 gives you a way out. You can use average rate. All right. So yes, average rate for bigger operations makes more sense. All right. You understand? Now, the thing is, obviously, if these two exchange rates are different, right, you will have an exchange gain or exchange loss on foreign operation, right? Exchange gain or exchange loss on foreign operation. Now, this exchange gain or exchange loss will be basically taken into a translation reserve. And this translation reserve is made part of OCI. This translation reserve is made part of what? OCI. You guys get
What
it?
is OCI?
Other comprehensive income.
Okay.
Other comprehensive income. All right.
All right. Thanks. Yeah.
Abdul Sattar, Mutaz, Angel, does it make sense? Everyone, please. Can you guys tell me if it
Yes, sir.
makes sense? Okay. Perfect. Now, you know that all these items, not just the closing net assets, but also the goodwill, if the goodwill has not been impaired, will also be translated at the reporting date. First, it was translated at the acquisition date, and now it will be translated at the reporting date as well. All right. Now, remember one thing. I'm going to tell you two more things, and then that's about it with IAS 21, right? Number one, when you dispose of this operation, if you remember in IAS 1 over here, I told you that there were certain items that basically IAS 1 asks us to classify within the OCI, classify what items will be recycled to the PNL and what items will never be recycled to the PNL. Gain or loss, exchange gain or exchange loss on foreign operation. Listen to me very carefully. Exchange gain or exchange loss on foreign operation, which is basically recorded in the translation reserve, is an item that will be recycled to the PNL over here. This is something that you already looked at in IAS 1, but at that time, obviously, you didn't know about it. So I'm coming back to this right now. Okay, you guys see this? So whenever you dispose of this operation, whatever cumulative gain or loss you have in the translation reserve will be straight away recycled to the PNL, and that recycling, after recycling it, because we know ultimately the entire profit or the loss is taken to the retained earnings. It's parked in the retained earnings, right? So it will be taken to the retained earnings. You understand? Guys, do you get this?
Yes.
Yes. Yes.
I know the energy is low today in the class because my mind tells me to be high on IS 21, but my mouth tells me to shut up. Okay. So yes. Now, one last thing. The reason why I'm telling this to you towards the end is because
Can I have one question
yeah,
before we
sure,
go
sure,
to the last thing?
sure, sure.
Okay, now we understand that for any like big institution, or like we take the average because it's hard to know each currency separately and we do it. Okay, but what about the small operation?
That's what
Shall
I
we
told you.
do
Small
average or
transaction date exchange rate. For every transaction, you take its
like
own
what?
exchange.
Sorry, on
Transaction
exchange,
date. Transaction date,
the
that means
transaction date.
that the
Okay,
date at which the transaction took place, you take the exchange rate of
okay,
that date.
okay, understand.
All right.
Okay, got it. Yes.
Now, what
But
factors
if we
determine?
apply
Yes.
it, is not gonna work. If we
If
apply
you
the average, it
no,
won't.
no, it will
Won't
work.
gonna work.
It will work. It will work.
So it's up to me. I can also apply average rate, right?
Yes, you can say that. You can say that.
Okay.
But the preference will always be given to the transaction date exchange rate. And the auditors know about this. So if you're going against that, if you're able to determine the transaction rate exchange rate and you're not, let's say you just because you don't want to do it, you want to take the average rate, the auditor might, stop
Not
you with it and say,
accepted.
yeah, exactly.
Yeah.
Now, the point is, guys, technically, if you see, since I'm the parent, I control the Dubai operations. Yes. I'm the parent, right? I control the Dubai operations. That's why I'm called the parent. So technically, my control should be enough to establish that the functional currency of Dubai operation is the same as my currency. My control over the Dubai operations should be enough to establish that the Dubai operations functional currency should be the same as that of my functional currency, right? But there are certain factors that will help you determine whether it will be the currency, let's say, of it will be dirhams or PKR. It depends. It depends on certain factors that we have to look further when it comes to foreign operations. All right. Number one. And, just let me tell you a crux of it. All these factors basically, determine what kind of autonomy that foreign operation has. The greater the autonomy, more chances that the functional currency is truly of the economic environment in which it operates. So, for example, the Dubai operation operates in Dubai, and the local currency is dirhams. So, dirham would be the functional currency of the Dubai operation. If it is determined to a good extent, to a greater extent, I would say, that the Dubai operations are autonomous. Okay, but if they're just an extension of my operation in Pakistan, if everything is being controlled from Pakistan, they don't have any such operations, they're just a branch, they purchase everything from me, they sell everything that I sell, I make their operating policies, whatever profits they earn, I repatriate it every year, the entire profits, I wipe out their accounts just because I want to repatriate the dirhams and convert to PKR. That's a different scenario. Okay. If they rely on me to provide finance to them every time, that's a different scenario. That shows that the business is not autonomous. And in that case, my functional currency as a parent would be the same as that of the subsidiary. That means, sorry, the subsidiary's functional currency would be the same as that of my functional currency, which is PKR. All right. So you have to understand that all these factors revolve around autonomy. Okay. So the first, generally, I would obviously summarize these factors for you. Uh, or you can say that whether the so extension is sometimes, extension established when obviously the foreign operation itself does not have any authority or autonomy to take decisions on its own. You guys understand? Frequency of transactions with parent. If the frequency of transaction is high, that means higher autonomy of the foreign operation or lower?
Higher.
Higher autonomy. If the frequency of transactions with parent is high, that means lower autonomy for the foreign operation because it depends on me as a parent more, right? For example, total transactions that, guys, there's background noise coming in. uh Sorry, what was I saying? Yes, okay. So like I said, the foreign operations, if let's say has 1000 transactions, out of that 800 transactions have been with the parent. So majority chunk of the transactions is with the parent, right? So where is the autonomy over here? You understand? Again, we are here to establish the autonomy, guys. Okay. This is a very crucial point. So this is the foreign operation. That's number one. I have another interpretation to it. Remember my example on repatriation, readily available.
No.
Foreign operation earns certain cash, right? And the cash flows directly affect my cash flows. Why? Because I remit whatever cash flows they have earned, whatever cash flows the foreign operations have earned, to my company or to my country. All right. So in that case, it shows that the business is merely an extension of my, the foreign operation is merely an extension of my company. It does not have autonomy. All right. You guys get it?
Not really, sorry.
Which part?
Like the last part for the example.
All right. Let me write down the fourth factor, last factor, and then I'll explain the third and the fourth factor, right?
Okay. I'll just be away for 1 minute and I will be back. Is that fine?
Sure. Sure, sure, sure.
Okay. Thanks.
In point two, you can call it either frequency or you can call it proportion of transactions, right? I gave you an example, right? 1000 transactions, out of that 800 transactions are with parent. So in that situation,
Okay.
it means that, okay, fine, if you are operating with a certain level of a certain degree of autonomy, okay, would you have a more widespread transactions or would you have more concentrated transactions, more widespread, right? You would have probably a lot of businesses, a lot of suppliers, customers, various other parties to transact with, and not just the parent. If you're transacting, if the
Okay.
most of the transactions are with the parent, that means there's a lot of cash coming in and cash going out, which shows that obviously, for sure, the parent is not dependent on you, right? So that means it's the other way around. You are basically dependent on the parent. So there's a lot of cash
Yes.
coming in and going out, or there's a lot of exchange of hands for the goods or services, for example. So in that case, you would say that, for example, the foreign operation has a lower degree of autonomy as as it would have been otherwise. You understand?
Oh, okay. So this is about the foreign brands autonomy,
Exactly.
not parents
No, no,
autonomy.
no, 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 no. Parent is
Oh, okay,
autonomous.
okay,
Oh, parent is autonomous. We are basically
okay,
trying to
okay.
decide over here whether the parent and the subsidiary, which is the foreign operation, will have the same presentational currency as that of the parent, because the group's
Okay,
functional
okay,
currency would be that of the parent, because the group, who owns the group? The parent, right? Who's the
okay, okay. Oh,
there's a
now
reason why
understood.
we call it the parent.
I thought it was reversed. That's why I got
No, no,
confused.
no, it's for the foreign operation. Okay.
Yes, yes, yes.
Similarly, for the third
Okay.
point, Amani, are you back?
Yes, I'm back.
Okay. For the third point, it says whether the cash flows of the foreign operations directly affect the cash flow of the parent. Now, if the cash flows of the foreign operation are directly affecting the cash flow of the parent, that means the parent basically repatriates or remits whatever the business, whatever the foreign operation earns, they remit it back to their company. Okay. So ultimately, this satisfies point two as well as it is in its own, essence, it shows that the foreign operation is merely an extension of the parent. That's all. Because whatever cash you earn, I take
Like
it
the bank
away.
is the main company. Okay, like for us, action. El Mazrui is the main company, is the holder company, and
Okay.
then they have like branches. Like for us, before Bahrain was only operation, but then
Uh-huh.
they seem to have like a management and everything. So is
Uh-huh.
this the same thing, or
Again,
this
the no, where do you
like
have
different?
branches? What other countries do you have branches in?
All the Gulf, like KSA, Qatar,
All right.
Saudi,
So that means if they are like, for example, okay, let me give you an example over here.
everyone has different
Are
currency.
they merely branches? Now let's look at the legal structure as well. If you're going into
Yeah.
this point, let's look at it. Now, is it merely a branch, that means it's just an operation registered in that country, or it's a company registered in that country?
For us, before it was only operation registered in that country in
All
Bahrain, but
right.
then after that they make it as a company itself.
All right. Number one. Number two, does the company have its own management?
And
Own
Bahrain, no,
management? No, no. Now
even
you're
until
answering the
now,
question.
yeah.
All right. So you're saying that the company does not have it, overseas operation does not have its own management. It's being centrally managed from, let's say, KSA, for example. All right.
But yes,
So in that case, what you need to further look at is whether the level of transaction. So again, over here, if you look at point number one, right? The
mhm,
activities with the foreign operation, are they to a significant extent? Is the frequency of transaction, is the proportion of transaction higher with the parent? Number three, whatever cash flow you earn. So for example, you have a foreign operation, right? You know what I leave
so
with you.
higher. If us is higher, that it's mean like we're significant. Okay, so based on this one, then the parent, which is the main company, we will not follow them currency, but then we will follow our currency because we're the
For the
significant.
no. Again, listen to me. For the local operations, for the local reporting, yes, you will follow your own currency. Over, for local, these points apply. The primary and the secondary conditions apply that we said earlier. I'm talking
Okay,
from the perspective of the parent. You understand?
okay,
From the perspective of the group financial statements. That is the perspective I'm talking about. I'm not
okay.
talking about with the individual companies, presentation, functional currency. All right, because if that is a company registered in that particular country, then obviously it's uh, basically for local point of view, from the local point of view, it's local, so it does not change, right? But from the parent point of view is what I'm looking at. Over here, what the points that we're studying are basically from the parent's perspective. You understand?
Yes.
Are you sure? The foreign operation will certainly report locally in their own currency. There's no doubt about it. But the parent has to decide whether the functional currency of the parent and the subsidiary is the same or not. Okay? Because usually a parent will choose its functional currency, for the parent, the functional currency and the presentation currency will be the same in almost all cases. Almost all cases. All right? Because they don't want to engage in the translation every time. Okay? You understand?
Yes.
Now, point 3, you got it. Point 4, financing of foreign operations, right? Is the foreign operation, or can the foreign operation finance its own business through whatever cash flows it has generated? That means, does it even have the right to retain those cash flows? If not, if the entire financing is basically driven from the parent, that means it has no autonomy. The foreign operation has no autonomy. And in that situation, what happens? The functional currency of the parent becomes the functional currency of
The
um,
brand.
the branch or the foreign operation. Okay, you guys get it?
I
Yes.
did.
Because again, the point is that you have to disclose these things to the group shareholders, and in that situation, what you have to do is you have to explain, because there are a lot of businesses that do not have just one subsidiary, just one foreign subsidiary. They have a lot of foreign subsidiaries, right? Just like Amanish told us that they have offices in the entire Gulf, Qatar, Bahrain, KSA. There is certainly a parent company situated somewhere, right? For example, Bahrain, right? So in that case, you have Oman, you have Bahrain, you have KSA, you have Qatar. The local operation for Bahrain, who's the parent, these are all foreign operations. But for the Qatari operation itself, they're locals to the Qatar. So yes, they are reporting in Qatari reals, right? But the point is, when it comes to the parent Bahrain, they have to figure out whether it should basically it needs to be translated because the functional currency of Qatar operation is the same as ours or not. Because for Bahrain's dinar, for Qatar is real. You understand?
Yes, correct.
Okay. So got too excited towards the end, I guess. Okay. So now it's all right.
Is that much boring our class today?
No? Sorry? You're saying something?
Is our class today is like boring that you so have you finished? Or
No,
it's
no,
because
no, no, no.
everyone
It's because I cannot shout right now. I
okay.
cannot be at the top of my voice right now. I cannot be excited right now. Otherwise, it will start hurting. Okay.
Yes.
So that is it for IS 21, guys.